Stop what you're doing right now. Look, if you own Rogers Corporation, or honestly, if you're just a retail investor who's sick and tired of getting burned by sneaky value traps in this crazy volatile market, you absolutely need to hear this. Because last week, I ran this 190-year-old engineered materials company through 5 rigorous valuation models, plus Warren Buffett and Peter Lynch's personal investment checklists, and man, what I found completely shocked me. Welcome to The Explainer. Today, we are unpacking the turnaround paradox of Rogers Corporation's Q1 2026 earnings. They make these highly specialized components for EVs and telecommunications, right? But their financials have been in this massive multi-year slump. So the big question is this suddenly a Peter Lynch turnaround dream or a value trap Buffett wouldn't touch with a 10-foot pole? Well, by the end of this explainer, you'll have a clear, actionable framework to decide exactly that for yourself. Okay, let's look at this shocking statistic that really forces us to pay attention. 178%. Analysts had literally penned Wall Street expectations for Rogers at around 68 cents a share. But out of nowhere, the company came out swinging with 75 cents. That means their adjusted earnings per share nearly tripled year over year. I mean, think of it like a heavyweight fighter, right? Getting off the mat in the 9th round to deliver a staggering knockout punch. When a struggling company posts a 178% leap like this, it's the ultimate pattern interrupt for the whole market. And, it wasn't just some clever accounting magic on the bottom line. Just take a look at management's own words here. All financial metrics met or exceeded the midpoint of Q1 guidance. Sales hit $205 million. That's up 5.2%. Plus, they expanded their adjusted EBITDA margin by a really impressive 580 basis points, coming in at 16%. In the immediate aftermath of this, the stock popped nearly 3%. So if you're looking at this quarter in total isolation, it feels like a slam dunk buy on anyone's checklist. But as any seasoned investor knows, you can never look at one single quarter in a vacuum. Which brings us to Section 1, the 5-year reality check. So here's where the turnaround paradox really begins to show itself. We've got this sudden Q1 net profit of $4.5 million, sitting directly adjacent to a trailing 12-month net loss of $61.8 million. Yikes. And look at their trailing 12-month revenue. It sits right around $820.8 million, which is shockingly close to where it was 5 full years ago. Demand has just been incredibly soft over the long haul. So that Q1 green bar of profit, yeah, it's doing some serious heavy lifting, trying to pull the company out of a very deep $61 million hole. And to make matters a bit more concerning, we really have to look at their earnings decay. Sure, revenue was flat, but earnings were actively shrinking by nearly 14% every single year. Basically, their fixed cost base acted like a heavy anchor during all this choppy demand. Adjusted operating margins declined by 5.6 percentage points over the last 5 years, just prior to this recent bounce. It's honestly a textbook example of a company struggling to trim the fat fast enough to survive a shrinking market. All right, moving on to Section 2, shifting end market demand. Now, double-digit growth in the industrial sector completely saved the day here, offsetting a really serious drag in automotive. Industrial makes up their largest slice of the pie at 37%, and they're seeing strong sales in the US and Europe, plus a nice little boost in mass transit rail. Meanwhile, automotive, which is 24% of their sales, actually declined year over year. The US electric vehicle market has been showing significant weakness lately, and that's dragging down light vehicle production. But thankfully, that industrial surge, paired with a pretty solid 18% boost from high-end smartphones, kept overall revenue afloat. Let's pivot to Section 3, measuring up to competitors. When we benchmark Rogers against an industry giant like Corning, well, Rogers' trailing net losses and that 3.11 price-to-sales ratio really highlight the massive competitive hill they still have to climb. Corning is out there pulling in over $15 billion in revenue and $1.6 billion in net income, commanding a price-to-sales ratio nearly 3 times higher. So Rogers is operating as a much smaller player, fighting a serious uphill battle against competitors who enjoy massive economies of scale and deeply entrenched global distribution networks. And even with the Q1 earnings beat, it's super important to note that Wall Street sees Infinel with roughly a 19% potential upside, whereas Rogers is still pegged with nearly a 6% potential downside from its current trading levels. So, the market definitely respects the Q1 beat, but analysts are demanding consistent proof before they fully buy into a long-term turnaround story. Which naturally leads us into Section 4, looking ahead to Q2. So what's the plan?
The company's actionable strategy relies on sustaining those EV and ADAS design wins while keeping a razor-sharp focus on operating expenses. And get this, those expenses surprisingly dropped 7% year over year. That is absolutely massive. It proves management is finally getting that troublesome fixed cost base under control. They are also targeting new capital expenditures, specifically for R&D, and they're openly hunting for mergers and acquisitions to basically buy some growth. Because even in a slow EV market, securing those future battery systems is totally critical for their pipeline.
And management is really putting their money where their mouth is, projecting Q2 revenue at $215 million. That easily beats Wall Street's $211 million expectation. That's a 6% year-over-year increase in sales on the horizon. But more importantly, they expect adjusted EPS to hit $1 at the midpoint, completely blowing past estimates of 79 cents. They are signaling loud and clear to us that Q1 wasn't just a flash on the pan. They expect this momentum to accelerate. So Rogers has proven they can beat the street/operating expenses and capitalize on industrial strength. But with that looming EV weakness and a history of stagnant growth, the ultimate question remains, is this the start of a Peter Lynch-style multi-bagger turnaround, or just a brief illusion in a 5-year value trap? The pressure is entirely on management now to prove that 2026 is the year the narrative permanently changes. Keep a very close eye on that Q2 print, guys. It will reveal exactly which side of the checklist this 190-year-old company truly lands on.